Good morning. My name is Bob Teska. I am the partner in charge of construction services at Bowers and Company CPAs. Today I'm excited to present the first in what I hope will be a series of short informational videos related to the construction industry. The title of the series is Weapons of Mass Construction. My goal is to bring you an array of topics from accounting, taxation, surety, and insurance presented in easy to understand and fun format. So with that, let's get into today's topic. What do underwriters look for when you request a bond? So just looking at what our overview will be today, we're going to go over briefly what a surety bond is and how that is unsecured credit, kind of like the credit card that you never want to use. Then we're going to look at the 3 C's, which are character, capital, and capacity. And then we're going to look at working capital and show how that's a measurement that comes right off of your balance sheet. So this is a diagram of a surety bond. Notice that there's 3 parts to this. You've got the obligee, the principal, and the surety. It's not an insurance contract like your car insurance, because that's between 2 people, yourself and the insurance company. And here we have 3 players. And you've got, it's a 3-party agreement where your work as the contractor is being guaranteed by a third party, the surety, to the obligee. So, for example, the obligee or the owner of the project wants to build a building, but he wants assurance that the contractor that he's going to hire is going to be able to complete that project. So he hires a contractor, and there's a contract between the 2 of them that binds them together. The surety comes in and he underwrites the contractor or the principal based on financial metrics and the 3 C's that we'll look at. And in between them, there's an indemnity agreement. Basically, the principal guarantees is personally liable for the surety bond. And then the surety guarantees to the owner of the project, the obligee, that the contract is going to be complete. So in the event that there was a problem with the contractor where they couldn't complete the building of the building, the surety would step in and get the contract completed, either by advancing funds to the contractor if they needed that, or hiring a different contractor at times. And then once the building is complete and the owner is satisfied, the surety then would seek remedies from the principal through that indemnity agreement. All right, so the 3 C's, which is part of the underwriting process that the surety goes through in relation to the contractor, both on the company and the owner of the company. The first one is character. And what they're looking for here is, have you used credit before? Do you pay your bills on time? What's your credit score? Are you behind any child support payments? Do you have a timeshare out there that you haven't made payments on? They're looking at capital. In particular, they want to know what your current assets that you have. Anything that can be turned into cash quickly excites them. But if you have land or a lot of yellow iron in the yard, that really doesn't excite the surety, because that can't be turned into cash quickly. They're looking for liquidity. So cash, accounts receivable, short-term investments, those are things that the underwriter are looking for. And then they want to know how you would deal with a short-term cash crisis. And how you would answer that question. So, that's why they like your cash and accounts receivable. Do you have bank lines of credit, things like that would help you deal with those short-term cash crises. And then your capacity. What's your ability to repay your debt? And what is your backlog? If you're a contractor that typically does $5 million a year in revenue, you currently have a backlog of $4.5 million, and then you're trying to bid a project that's $3.5 million, they're going to look at your capacity and say, does it make sense? Do you actually have the capacity to take that contract on and complete it without suffering losses? Okay, so looking at working capital. It's a measurement of the company's short-term financial health or their liquidity. And it's a calculation that comes right off of your balance sheet. And the calculation is very simply, you take your current assets, you subtract your current liabilities, and that number is your working capital. To simplify, the more current assets you have, the more working capital you have. And conversely, the more current liabilities you have, the less working capital you have. So words are awesome, but we'll take a look at this in numbers. So here's a balance sheet here of Bowers and Company Builders. And as you can see at the top, we have some current assets of cash, contract receivables, and then we have cost in excess from our work in process. The total of these three items are our current assets, and that's $867,500. And then if you move down to the liability section, you've got your accounts payable here and your billings in excess, and the total of those are $500,000. Those are your current liabilities. So your working capital calculation is this $867 minus this $500,000 gives you your working capital down here of $367,500. Now, what usually happens is the surety company will take your working capital and they'll give you a multiple. In this example, we're going to say it's a 10-time multiple or a 10 times case. That's just kind of a rule of thumb. Depending on the type of contractor you are and what your balance sheet looks like, it could be 3 times working capital. It could be maybe 12 times working capital. But for this example, it's a 10 times case. So you take your working capital here that we had of $367, we multiply it by 10, and our bonding capacity with this balance sheet, unadjusted, is going to be $3.6 million, almost $3.7 million. That would be our bonding capacity. But the surety doesn't just take your balance sheet at face value. They underwrite what's actually in the balance sheet. So cash is cash. There's usually no adjustments there. So we have, on our balance sheet, $575,000 of cash, so that stays. Here are their contract receivables of $250,000. They're going to look at that, and they're going to look and see what makes that up. They're going to look at your accounts receivable aging. Do you have a lot of receivables that are over 90 and 120 days? If you do, the surety looks at that and says, well, the likelihood of those being collected get less the older the receivables are, so they usually discount them or write them right off. So in this case, we had $250,000 of receivables. There was $20,000 in the over 90 days column. So what we're left with is adjusted receivables of $230,000. And then with our cost in excess here of $42,500, typically sureties don't like to see underbilling. They don't like to see that you've got work that you could have billed for that you didn't. So they usually will deduct most, if not all, of your cost in excess. So in this case, we have $42,500 of cost in excess. They will deduct that in entirety in this example. So the $42,500 goes away. So now our current assets are just the cash of $575,000, our adjusted receivables of $230,000, and it's now $805,000. So our current assets have gone down $62,500. In the liability section, typically not many adjustments are going to be made to accounts payable, so those carry right over at $125,000. Now the billings in excess here, this is where that you overbilled for the work that you've done, and it is a liability, but it's a good liability as long as you've got cash in the bank to offset it. And in this case, we do. We've got $375,000 of billings in excess and $575,000 of cash. So we've overbilled, we've collected the cash, and now it's sitting in our bank account. So the surety sees this as good because now you've overbilled and you're working with someone else's money. So what they do is they give you like a credit of about 50 cents on the dollar for your billings in excess. So that liability gets cut in half here. So we had billings in excess of $375,000. We're kind of getting a credit here of $187,000. So we're left with billings in excess of $187,500. You add that to our payables. So our adjusted current liabilities number is $312,000. Now, when you take our current assets of $805,000 minus our current liabilities of $312,000, we get working capital of $492,500. Still using the 10 times case. Now our bonding capacity is $4.9 million in comparison to the $3.6 million that we did have before adjustments were made. So our bonding capacity has gone up by about $1.3 million. Now, depending on what made up the balance sheet, the adjustments could actually drive the bonding capacity down. But in this case, it would have driven it up. So we're going to get a bonding line of approximately $5 million. So just some kind of takeaway things here on working capital. Cash is king. You should work to preserve it. You want to avoid excessive distributions. You don't want to buy a boat. You don't want to buy a restaurant. You take enough risk every day in the construction industry. You want to avoid paying cash for equipment. I know a lot of people out there don't necessarily like to have debt, but when you take a short-term asset like cash and you purchase a long-term asset like a bobcat, backhoe, something of that nature, it distorts your balance sheet. You're trading short-term funds for a long-term asset, and your working capital drops exponentially. So it's much better in those situations to purchase a long-term asset with long-term financing. Then only the current portion of that debt would affect your working capital, the next 12 months worth of payments. You want to minimize your underbillings because those get adjusted, in the most part, right off of your balance sheet when the surety adjusts for your working capital calculation. You want to maximize your overbillings because the sooner you can get the bill out, the sooner the cash comes in, and the more cash you have in the bank, and then you're building the project with the project owner's money, not your cash or your line of credit. You want to have access to short-term capital, and what I'm speaking of in particular here is a line of credit from a bank, and you want to maintain good banking relationships. And, I would suggest that you have multiple banks that you do work with, at least two, because there are banks, they say they like contractors, and then something changes in upper management, and then all of a sudden they don't like contractors. And I've had clients where they just get a letter in the mail, and they say, we no longer want to do business with you, and close the accounts, tell them they need to refinance any outstanding debt that they have. So you don't want to be in that situation. So having good relationships with two banks is just a good business decision. So that's going to conclude this topic today. If you have any questions on this topic or any other topic, please feel free to reach out to me. My contact information is on the screen. And with that, we'll see you with episode 2. Thank you.